So, let's talk about BlockDAG. This is a name you've probably heard buzzing around, and they just hit the crypto exchanges. The token is officially live, which is huge news. But there's a shocking twist for the thousands of pre-sale investors who got in early. They can't deposit their tokens. They can't sell. So what on earth is going on here? Is this some kind of brilliant long-term strategy, or is it just a massive red flag? Let's break it all down.
And that really is the million-dollar question, isn't it? On one hand, you have a project doing something, well, very unusual with its launch. And on the other, you have a lot of early investors feeling like their funds are basically being held hostage. We're going to dig into the facts here, look at both sides of the argument, and try to figure out, is this a scam, or is it something way, way smarter?
Okay, this slide really puts the whole conflict in a nutshell. The good news? Hey, the BDAG token is real. It's trading live on actual exchanges. But that good news gets totally torpedoed for the pre-sale folks because their deposits are completely blocked. Can you imagine that? You backed a project from the start, you watched it grow, and the day it finally goes live, you're stuck on the sidelines just watching. It's a super frustrating spot to be in for thousands of their earliest supporters.
So that raises a pretty obvious question. If the people who bought in first can't sell, who in the world is trading this thing, and where are they doing it? Let's take a look at the exchanges where BlockDAG has actually shown up. Right now, the BDAG and USDT pair is live on a handful of centralized exchanges. You know, places like Bitmart, LBank, and CoinStore. And it looks like a decentralized exchange is on the way too. The main takeaway here is that yes, trading is actually happening. But, and this is a big but, the liquidity is really low. That just means the price is super volatile, jumping all over the place. And most importantly, these trades aren't from the thousands of pre-sale investors. They're still locked out. Which brings us to the most critical question of all. Why? Why are these deposits locked? Well, according to the BlockDAG team, this isn't some glitch or a bug. They say it's a feature. It's a core part of what they call their anti-dump strategy. You know, the idea of an anti-dump mechanism is meant to solve a really common problem in crypto. We've all seen it. A new token launches, and all the early investors who got in cheap just rush for the exits to cash in. They flood the market, the price absolutely tanks, and it can kill a project's momentum right out of the gate. BlockDAG's argument is pretty simple. By controlling when those presale tokens hit the market, they claim they're actually protecting the price for everyone. Okay, so if it's a strategy, we gotta understand how it actually works. This isn't a case of your tokens being locked up forever. The whole plan is built around what's known as a vesting schedule, and it's based on a pretty specific 40-60 split. Here's how it shakes out if you were a presale investor. At the moment of launch, the token generation event, you got immediate access to 40% of all the BADG tokens you bought. That was your initial chunk. But the other 60%, the bigger slice of the pie, that's locked up and put on this vesting schedule. So you get some of your tokens up front, but the vast majority is held back for later. So what about that big locked up 60%? Well, it gets released bit by bit over 3 months. You get 20% after the first month, another 20% after the second, and the final 20% in month 3. This whole staggered release is really the heart of their strategy. The goal is to prevent that one single massive sell-off on day 1 that could crush the price. And now we are at the very heart of this whole controversy. We get the what and the how of their plan. But the real question is this a genius move to make sure the project survives long-term? Or is it just a huge red flag that basically slaps their earliest supporters in the face? Let's look at the arguments on both sides. I mean, the two perspectives here could not be more different. You've got the genius plan crowd who say this is great. It protects everyone's investment by building a stable price floor and preventing a crash. But then you have the red flag side, and their concern is totally valid. They're saying, wait a minute, we put our capital at risk when this was just an idea, and now we can't even access our own assets? It brings up some really serious questions about trust and control and whether the team will even stick to their own schedule. Now, to push back against all those scam accusations, the project has 3 main points they keep hammering home. First, they say their code was audited by 2 very well-known security firms. That's a good thing. Second, the token is trading live. It's not vaporware. And third, this clearly isn't one of those classic exit scams where the devs just take the money and vanish. The team is still here. They're still active and communicating, even if their methods are making a lot of their early believers pretty nervous. All right, we've looked at the exchanges, we've unpacked the official strategy, we've seen the mechanics of the vesting schedule, and we've heard the arguments from both camps. Now that all the pieces are on the table, it's time to put it all together. So we end right back where we started. Is this whole vesting strategy a necessary evil, a smart way to build a sustainable project and protect investors from crazy volatility? Or is it an unacceptable way to treat your earliest supporters that sets a really dangerous precedent? Is this the new blueprint for a fair launch, or is it a tactic that just makes you want to run for the hills? The answer to that, well, that's a judgment call every single investor has to make for themselves.